Now, talking a bit on specifications of market risk factors. Now, it's very important that banks use their market risk factors very, very carefully and ensure that appropriate risk factors are included. So, this is also something which we call as the appropriate data mapping process. Now, why we call this as data mapping process? Because we can think of this as some kind of a mapping. So, imagine that a bank is using some kind of a treasury management system. Imagine something like a Murex, maybe, for example. So that Murex could be connected with a certain market data provider. So think of maybe Bloomberg or Refinitiv, etc. So think it's Bloomberg for now. So when we say a data mapping process, the bank will need to ensure that all of the data points are mapped appropriately inside Murex. So depending on the kind of positions which the bank is holding on its books, it will need to ensure that those inputs flow in from Bloomberg, because Bloomberg is there here in this case is the primary data provider. So whatever data is coming in from Bloomberg, that needs to be fetched and mapped at appropriate data points within the Murex system here. So, so that's why specification of market risk factor is important. If this specification itself is not clear, then the problem is some risk factors may not be mapped or maybe incorrectly mapped, which is dangerous, because then effectively what we are saying is we are unable to capture certain risk factors, and naturally they are simply getting ignored from the calculation. So that's why meeting these certain requirements on specification is the key. Any misstatements of these risk factors or incorrect mappings which might result in stale risk factors coming in is disastrous for any bank. So that is unacceptable. So that's why this specification of risk factors becomes very, very important. So let's start one by one. So we have the general interest rate risk first, GIRR part. So so it says that inclusion of interest rate risk factors in each currency in which bank has positions, both on and off balance sheet. Naturally, because uh, for example, let's say I have a lot of positions on the MIBOR OIS curve. Then I'll have to take multiple points around along the MIBOR OIS curve, and that will have to be mapped onto my system, so that all those inputs are then consumed for a variety of operations. So maybe I could have certain on balance sheet positions, maybe like a credit link note or something, and maybe an off balance sheet position like a LC or BG or something like that. Now, banks should have in place a model for modeling the yield curve using any one of the accepted approaches. So this is where expertise around interest rate modeling comes very, very useful. So interest rate modeling is a very interesting area to work in, and it's like one of those evergreen roles as we call in banking. Because as long as banks and lending institutions exist, and there's always going to be demand for good quality rates modeling. So even as a part of this guideline, and the bank will need to have expertise to do yield curve analytics or do modeling of yield curve. Also, splitting of the yield curve into multiple buckets to capture the variation and volatility along the curve is important. So imagine that this is my yield curve. We have to split it into multiple buckets. So we have a bucket one, a bucket two, dot, 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 up to bucket n. Why this is required? Because each of the segments along the yield curve is going to be exposed to different market forces. So maybe different liquidity conditions and other market forces. So that's why ability to split the yield curve into multiple buckets and then doing a variation analysis is the key. So something which every bank should be able to do. And for positions which have material exposure to interest rate movements in major currencies, so think of those big major currencies like USD, GBP, CHF, etc. Now, banks must model the yield curve using at least 6 risk factors. So this is a bit on GIRR risk factors. Then coming to CSR, credit spread risk, the bank has to incorporate a separate risk factor model to capture credit spread risk. So it could be some kind of credit spreads modeling also, because that is something which many interest rate modeling teams do as well. So in addition to yield curve analytics, they might also want to do some analysis on spreads as well. For FX or foreign exchange, the banks might include the RFs corresponding to each. So RF is effectively risk factor. So just an acronym which I commonly use. So banks must use RFs corresponding to each foreign currency position on the book. So let's say USD INR or Euro USD, etc. Banks must incorporate RFs corresponding to exchange rates between the domestic currency and foreign currency, which the bank has exposure to. So effectively, this means that even if we take any FX position for the bank, then it should be able to tackle or it should be able to capture the relevant risk parameters correctly. Equity risk. Now, inclusion of risk factors specific to each equity market that the bank holds significant position. So maybe, for example, if I take an example of the Indian market, let's say there's an Indian bank, then they might be trading on certain equity positions on the National Stock Exchange of India. So that way, NSE becomes like a or NSE index becomes like a risk factor. Now, at the minimum, at least there must be a risk factor that is designed to capture market-wide movements in equity prices. So, usage of a market index to represent broad market. So, broad market may be a Nifty 50, which is like a popular index, or it could be any other broad market index for any other exchange as well. And for positions in individual securities, banks must use beta equivalents relative to the broad market index. Why beta equivalents are important? Because as we know, the idea of beta is also what we call as a systematic risk for equities. So beta effectively tells how sensitive a certain equity position is vis-a-vis the broad market. So that's why this talks about the beta equivalents. Now, it would also be additionally beneficial from a risk management standpoint if the bank would follow a detailed approach to include risk factors corresponding to vols or volatility of individual equity issues, whichever it has positions in, and risk factors corresponding to different sectors of overall equity market. So, industry specific index. So, when I say an industry specific index, you can also think of something like Bank Nifty, which is like a bank specific index which is available or which is listed on the National Stock Exchange of India. For commodities, inclusion of risk factors specific to each commodity in which the bank holds positions. So bank would be holding positions in let's say crude oil or maybe sugar, wheat, etc. Now, if a certain bank has only limited positions in commodity businesses, then it may specify one risk factor for each commodity price that it's exposed to. So, this is like a reduced requirement on the amount of risk factors required. But if the positions are limited, this is fair enough. And should use a different risk factor across different geographies because naturally we know that as we look at different geographies, the commodity markets are going to behave differently, isn't it? So, that's why this point on geographies. Also, if the overall positions are very, very small, then the bank may use one single risk factor as a representative of a broad class of representative commodity. So that way, let's say I'm talking from a oil's perspective, uh, but imagine that the bank has a very small position. Then having too many risk factors here is more of a overkill, which is not required. So in this case, a single risk factor for all grades of oil could be used as well. However, if the bank is trading actively in commodities, which can always be the case because certain banks have very active trading desks as well, then the internal model for the bank has to take into consideration things like convenience yield between the derivative and cash positions in the commodity. Now, so for those of you who have already read about futures in the past, will be familiar with the concept of convenience yield. But otherwise, the meaning of convenience yield implies that this is like a benefit which we look at for whenever we are looking from a derivative vis-a-vis a certain underlying position. So, for example, there could be benefits for let's say a tire manufacturer if they have a certain inventory of raw rubber which is available for further processing. So those are things which we try to relate from a convenience yield point of view. But it's a very common terminology when we talk from a commodity futures point of view. And risk factors under internal models. So banks to ensure that the risk factors that are used in valuation are also used for risk factor in the bank's internal model. So there should not be a gap as such. So that way we are using comparing apples versus apples. So that's why it should be those same set of risk factors. Also, the expected shortfall model has to include risk factors corresponding to the regulatory risk factors specified under each of the risk classes under SA. So that way, uh, banks will already have their SA implementation. So the same thing needs to be adopted here as well. And also for both expected shortfall and any kind of stress scenarios, the non-modelable risk factor should be able to capture, I mean, things like correlation risk, basis risk, so ideas from the credit spreads point of view, and even non-linearity in options and option embedded products, including securitized positions or secure.